More than half of all stock buybacks are now financed by debt, and here's why that's a problem from Fortune magazine. Let's read a few sentences out of this. Okay. The era of cheap borrowing is fostering corporate America's favorite investor-pleasing activity, share buybacks. Indeed, more than half of all buybacks are now funded by debt, and while there's an argument that repurchases benefit share prices and investors, at least in the short run, it's questionable whether highly indebted companies should be doing this. Sort of like mortgaging your house to hilt, then using it to throw a lavish party. Okay, we're not going to go too deep into this one. We will pick out a few paragraphs from this, but I think before we even read this one, we all kind of agreed. We all have a kind of different outtake on this than the author of this article. What do you guys think about this? I mean, the article, if you actually read the whole thing, it really never gives you, until you get to the very last paragraph, and I'll read it to you, it never really gives a super negative why this is so negative. It says here, but that's not stopping America and some others, despite their high leverage, from paying investors for their shares. And other than a recession, which generally knee-hauls buyback plans, don't expect companies to ease off their repurchases. But once a recession inevitably arrives, the results may not be pretty for companies with lots of leverage, in no small part due to buybacks. With corporate debt now higher than its peak in scary late 2008, Dallas Fed President Robert Kaplan has warned overly leveraged companies could amplify the severity of a recession.
Everybody says could.
Yeah. Well, yeah.
Because nobody knows. Nobody knows what the leverage is. And when with interest rates where they're at, why wouldn't a company take shares off the table, stabilize the value of their company, and put it in debt at the values that they are today, the interest rates that they are today?
Mm-hmm.
I mean, the whole thing that you don't know is it a floating rate interest rate? Is it a fixed interest rate? Have they put out a 20 or 30 year bond at a fixed rate at these levels, and at some point interest rates will start moving up, and these guys are going to look like heroes leveraging a buyback with a bond or debt at these interest rates. But I mean, I have to look back and remember when we were in 2007 and 2008, and you could go out and you could buy a home at 125% of value, but nobody seemed to have a problem with that. And yet when a corporation goes out, buys back stock, and finances it in the 3 to 4% range, it's a problem.
Yeah, and that's where I come back to say, I think this author that wrote this isn't being completely clear. I really dislike when a journalist or an author titles their article with something that's a statement and then says, here's why that's a problem. Because you, the reader, are now assuming that, well, more than half of stock buybacks financed by debt must be a problem.
Right.
Well, if you read it right down here, last part I'll read, it goes over some of the examples of major companies. Apple, Oracle, Cisco, Bank of America, and Pfizer all have double-digit billion stock buybacks in the last 12 months. Next sentence. Okay, they have pretty good balance sheets, but what about companies that are heavily debt-laden? Okay, so there you go. That's a fair argument. It says AT&T and Time Warner. Yeah, those are media companies, communication companies. They have a ton of infrastructure and a ton of debt. So yeah, that could be dangerous for those types of companies. But for the most part, Apple now has even more cash on hand than it ever has.
Right.
Look at the utilities, though. I mean, if we're talking about debt-laden companies, utility companies have a ton of debt. But nobody seems to think that your lights are going to go out because you're paying your light bill every month or your water bill every month. And they have these, what we talked about today, in essence, as a subscription that regardless, utilities might have a huge debt for their infrastructure, but you kind of have to have the utility.
Right. So what do you think about, Chelsea? What do you think when people say stock buybacks are just a way for the greedy capitalists and the 1%ers to make a bunch of money?
I just kind of going back to like school and like what we learned in school. I feel like when you hear that a company is buying back stock, it does have that negative connotation that something's wrong. Like, why would they want to buy their own stock back? Why wouldn't they want to increase their shareholders? So I think maybe that's why the author titled it that way, because there's already a kind of like a negative stigma on if a company does buy back their stock, then there is something wrong. They're trying to reel everything back in to, I don't know, cover something up. I don't know. Obviously more of the specifics, but kind of going back to what your dad was saying is we don't know what's going on. It could be something negative. It could mean that there's a problem in the inner workings of the company. It could be that they just feel that they need to in order to stabilize their books. They need to get a better hold on their company. We don't know. And so until you actually dive into more of the, I don't know, the information, the data, it's really, really hard to skepticize what's going on.
History shows that CEOs generally do a stock buyback at the worst time.
Yeah.
When the stocks are at a high, as opposed to when a stock's at a low. And then the question is it different this time simply because interest rates are so low, and now they're doing a stock buyback and financing it with debt, and only time will tell whether it was a really good buy or not.
Let me read a few comments on this article here, and we'll see what other people are saying. You guys can comment on what some of these folks are, what their opinion on this whole thing is. Top comment here says, kind of like what you mentioned earlier, Bruce, it all depends on the terms of the bonds. Fixed rate, non-convertible, go for it. Floating rate, forget it. What's the worry? The Fed won't raise interest rates in a recession. The only time interest rates will go up is when the economy is booming, in which case the companies can make the interest rate payments anyway. So, yeah, again, doesn't seem to be that big of an issue. Next comment. So one thing this piece doesn't really mention is sometimes issuing debt to pay dividends or buybacks are driven by a tax dodge. Apple, for instance, has billions of earnings from overseas. If it repatriates the money, it's subject to U.S. taxes. So instead of repatriating the money, it borrows large sums cheaply around 2.5%. Considering inflation is targeted to be around 2%, this cost was very low, and it would be cheaper for them to borrow money to pay dividends than use their offshore cash. So part of this is just cheap debt. That's actually an interesting thing. I never considered that. Everybody knows a lot of these companies have overseas cash, and I guess if you want to bring some of that cash back, and what are you going to what are they going to pay right now? What's the corporate tax rate they'd have to pay on repatriating?
Well, that's the question, because some of them in this new tax bill that Trump put out was that they were trying to get that so that they would bring it back without paying a tax.
Yeah. Right.
Now, I don't know where that's at, whether it ever went through, but corporate rates are what, and I don't know even where they're at right now.
Yeah. So I'm sure some of the number crunchers up top at Apple and those companies are doing the math and saying, hey, it's easier for us to just do a stock buyback, borrow money at 2.5%, 3%, and then grow 2.5% and 3%.
Right.
To cover it. That's actually an interesting angle I hadn't considered before. Just one or two more comments. The real question is, why are so many banks willing to lend highly leveraged companies hundreds of millions of dollars at 2 to 4% interest? Good question. And last one I'll read here. Companies don't go bankrupt because of debt. They go bankrupt because their cash flow dries up. As long as companies can maintain enough cash flow to support debt servicing plus operations, they'll be fine. Let's remember that some of the largest holders of external debt obligations are also companies with huge surpluses of cash, like Apple. So that's what we said earlier. So, yeah, interesting comment there.
On it, yeah.
Mm-hmm.
People are willing to buy government bonds from Germany at a negative interest rate, and so why wouldn't you think that buying a bond that Apple puts out, or that Pfizer puts out, or some of these other companies that are financing stock buybacks wouldn't be a better buy for an investor than trying to buy a bond that's already negative interest rate, that you know that you're going to lose money on the bond if you hold it to maturity? I don't think the stock buybacks, and you have to look at each one individually.
Yeah.
Historically, like I said, stock buybacks on their own merit are generally done when the stock is at a high and not at a really good buying opportunity. That probably has something to do with it, because then everybody would say, well, then that means the market's too high if stock buybacks are all getting done right now. But you don't know that the stock buybacks aren't specifically simply because interest rates are so low right now that it makes sense to finance a stock buyback at a 2 or 3% interest rate, thinking that 2 years from now or a year from now, they could be financing that same debt at 4.5 to 5.5%.
So here's one last question for you, and Chelsea and I can't answer this because we weren't alive then. Back in the 80s, when interest rates were in the 15 to 16, 17%, would that be what would you see for stock buybacks at that point? Do you suspect? You think they'd be pretty low, considering, well, at least if they were financed by debt?
Stock buybacks. Every year there are stock buybacks.
But back then, or in a time when interest rates would be that high,
I'm not
would
sure
you
they
see
would
that
have financed it with
right,
that type of debt. It would have been probably a floating rate or an adjustable rate, because it's no different than at that time you would have probably bought, if you were buying a house, you would have probably bought not either if you buy a 30-year mortgage, then you have to go in and refinance it, or you could get a 5-year adjustable, which means every year you have to adjust the interest rate. Well, if you're paying 11% on a home, which we did in 81, 5 years later that interest rate is not 11%, and now it's at 8%. So now you refinance it at that.
Okay.
And you do the 5-year adjustable. So chances are that corporations at that time that were doing stock buybacks were doing adjustable rates, and I would almost bet today they're not doing adjustable rates. Now, they might say that in the article, but there's very, very few companies that I would think that would make sense for them not to lock in a long-term rate at these levels.
Okay. All right, everybody. Well, you heard it. Stock buybacks being financed by debt. Is it a problem or not? Who knows? But thanks for watching. See you next time.